So let's take that to an even broader question. So one of the things that I struggled with for a very long time is the idea of basically how can you square value investing outperforming other principles or other strategies in a market that there's very strong evidence that it should be and is efficient. And I've struggled with that for a very long time because I was not willing to accept that I or all the value investing heroes out there are so much smarter than everybody else on earth. I mean, it could be the case with a few people. We know that some of value investing heroes are geniuses. But how can so many people outperform in an industry that attracts extremely intelligent people? I was not willing to accept that everybody else was an idiot or being irrational or being stupid about things. And the more I thought about it, the more I started to realize that the market is actually efficient. It's just efficient about different goals. Let me put this another way. We all know the concept of agency problems, and I think value investing works because of a massive agency problem. So look at any market in the world. The bulk of equities, for example, are owned by institutions, so endowments and pensions and entities that should have a 100-year investment horizon, right? But we also know that fund managers look at the next month and the next quarter. And how do these things come together? The reason this thing happens is that those endowments have boards, and those boards are probably on a 4 or 5 year election cycle, and they have to appoint investment committees. And so those investment committees are going to be judged by the board, and so those investment committees probably have a 2 or 3 year investment horizon, and so they go out and they find third-party managers. And they have to measure those third-party managers over a 1 or 2 year investment horizon. And the firm manager, the firm has to judge the portfolio manager who's actually making the decision quarterly, because if they don't, then the yearly results are going to be bad, and if the yearly results are going to be bad, and take it all the way up, and they're going to get fired, basically. And so the portfolio manager thinking about next quarter's results is being perfectly rational given A, his or her incentives, and B, the risks that he or she are facing. The average portfolio manager has a risk that they are not willing to accept of getting fired if they don't have a good quarter or a good year or a good couple of years. Now, if you are a value investor and you've positioned yourself or your firm to be able to look beyond 2 years, so 3, 4, 5, 10 years, and if you genuinely, and this is a thing that you have to structure your firm and your client base and your way of thinking around. If you're genuinely not bothered by short-term volatility and what happens next quarter or next year, then the risk, the career risk or whatever you want to call it, that the average portfolio manager is not willing to take, you're willing to take that, and the market is compensating you for taking that extra risk. It may not seem like a risk to you because you've positioned your strategy and your firm so that it doesn't threaten you, but for the majority of investors in the market, it's a real risk. Underperforming during a year is a risk, and so the market is being perfectly rational and efficient by compensating you with a higher return for taking on that risk. That's how I see it.